It's the Real News Network. I'm Greg Wilpert coming to you from Quito, Ecuador. The IMF and World Bank are holding their annual spring meetings this week. In advance of this meeting, the IMF released its World Economic Outlook report for 2018. It is a fairly optimistic report, which estimates global economic growth at 3.9% for both 2018 and 2019. The IMF, though, says that there are clouds and risks on the horizon and makes a few suggestions on how to deal with them. Joining me to analyze the implications of this IMF report is Mark Weisbrot. Mark is the co-director of the Center for Economic and Policy Research and is the author of the book Failed: What the Experts Got Wrong About the Global Economy. He joins us from Washington, D.C. Thanks for being here again, Mark.
Thanks for having me, Gregory.
So let's start with the general issue of the IMF. There seems to be a general perception that the IMF has changed its ways and adheres less to neoliberal economic orthodoxy than it used to. For example, in Greece, it seemed to play the good cop to the European Central Bank's bad cop. But the report seems to recommend some typical neoliberal austerity. So how seriously do countries have to take these types of IMF recommendations?
Well, the IMF does have a lot of influence, and I think the perception that they've changed is really based on mostly what comes out of the research department. There have been some significant changes there, but their policy has changed very little. And you can see that they're having their World Bank and IMF annual spring meetings here in Washington. And this is a big event where you get finance ministers from all over the world, and the press comes and reports on it generally. And this is where you see their World Economic Outlook, which you mentioned, gives their take on the world economy and what they think countries should do. And we'll get to that, but I just want to say they have a lot of influence, first of all, because they loan money to some countries, mostly developing low and middle income countries, but they also had influence in Europe, as you mentioned. And they also meet with the finance ministries of member countries regularly, and they issue papers, a joint paper, which represents kind of an elite consensus on what the economy of the individual countries is doing and what they should do. And here you see a real pattern that's very similar to what they're saying. So in these papers that they do, these joint papers called Article 4 papers, you see repeated calls for cuts in healthcare spending, budget cuts generally, labor law reforms where that generally weaken the bargaining power of unions and organized labor. And this is a very consistent pattern. And right now, of course, you see the speeches, for example, from the chief economist at the IMF, saying that the growing economy is a good time for what they call fiscal consolidation. In other words, countries should use this opportunity to cut spending, tighten their budgets, and reduce their debts. And so this is, in a lot of countries, this is going to be the wrong thing to do.
So let's turn to the actual report that I mentioned in the beginning, the World Economic Outlook. And in one of the things that it's warning about, there's several different issues, though, and let's start with one of them, which is that they're saying that employment rates in so-called advanced economies could rise actually above full employment. So first, how can an economy be above full employment? And second, is this and could this be a problem?
Well, it's not a problem really for any country that I can think of, but they do say, for example, that the United States will very soon be above full employment. And they say this despite the fact that, there's still slack in the labor market here. You still have if you look at the employment rate for prime age workers, 25 to 54, it's still below its pre-Great Recession levels, and it's even more below the level we had in 2000. So there's room for more workers to be pulled into the labor force, and the IMF is saying, well, no, actually, that we're moving above that. They say we're moving above that for the what they call the advanced economies, the high-income countries as a whole. And even for Spain, for example, where there's over 16% unemployment, they project this year that this is basically full employment, that they've reached their maximum level of output. So what do they mean by more than full employment? They mean that the economy is producing more than it can reasonably produce without going to accelerating, some kind of accelerating inflation. And this is their problem, the problem that they've had for years. They're just overly conservative on inflation and how much employment that these economies can reasonably have. Certainly for Spain, there's something terribly wrong with their definition of potential output or full employment level of GDP. If you have 16%, over 16% unemployment, and they say that you've reached your potential.
Just briefly, what's the problem if there is full employment and supposedly inflation? Sorry, if there's if they predict that, and what's the policy recommendation, and what's the issue with that?
Well, that's the problem. They're endorsing the kind of monetary policy, for example, that the Fed is pursuing. The Fed is raising interest rates, and the Fed is going to raise interest rates, according to the IMF projections, considerably faster than they expected just 6 months ago. And what happens is this reduces employment. This reduces the growth of employment and can even cause a recession. In fact, in the post-World War II period, our recessions were all triggered by the Fed raising interest rates, except for the last two, which were caused by these bursting asset bubbles. So this is a real danger, and it's kind of ironic that this is the one thing they don't mention in their World Economic Outlook as a threat, a risk, a downside risk to the world economy, when it's probably the biggest one. The Fed raising interest rates can, in fact, slow the U.S. economy unnecessarily, even tip it into a recession, and it affects interest rates and economic growth all over the world as well. So this really should be, if you're thinking about the risk of the global economy, this is a serious risk where the idea that the U.S. debt or any of the rich countries' public debt is a problem is really far-fetched.
Well, let's actually turn to that issue. In the press conference that Maurice Obstfeld, which is one of the research directors, I believe, what he had to say, and we've got a clip.
As our new fiscal monitor to be released tomorrow documents, global debt levels, both private and public, are historically high, threatening repayment problems as monetary policies normalize in an environment where many economies face lower medium-term growth rates.
So, looking at this question, this issue of debt levels, you already started talking about it. But what's your response to this problem of global debt levels? I mean, aren't global debt levels incredibly high?
You know, the public sector debt, for example, the United States public sector debt is not a problem because, for several reasons, but one is that we're only paying about 1% of GDP in interest on that public debt. And that's about as low as it's been in the whole post-World War II period. So this is not a problem. And it wouldn't be a problem even if it got considerably higher. Also because the United States maintains the world's most important reserve currency, the dollar. And that means that we really don't have the kind of possibility of a balance of payments crisis or anything that would shoot up the interest rates on our debt for other reasons. So there really isn't a problem there. And if you look at the European countries as well, most of them have very reasonable and low, relatively low, historically low levels of interest payments on their debt. That's the main problem. You know, if you have a big credit card debt and you have almost zero interest on it, then that debt isn't a big problem. And it's the same thing with the public debt of countries.
Okay, let's turn to the other issue that Maurice Obstfeld mentions, which is the possibility of a trade war.
The prospect of trade restrictions and counter restrictions threatens to undermine confidence and derail growth prematurely. While some governments are indeed pursuing substantial economic reforms, trade disputes risk diverting others from the constructive steps they would need to take now to improve and secure growth prospects.
So, Mark, what's your response to this possibility of a trade war, that this could be a danger to the global economy?
Well, if you had a real full-blown trade war, it would cause considerable disruption, but we're just nowhere near that, and I don't really see it on the horizon. I don't think you see, I mean, who is going to cause it? You know, Trump obviously makes threats, but he makes a lot of threats and he changes his mind every other day, and he has a whole government and corporate lobbyists and people in his government that are against this. And it's hard to see him by himself starting a trade war, or even the other countries retaliating in a way that would really accelerate it. I don't see this on the horizon. And again, the much bigger threat is the Fed. What the Fed is already doing to raise interest rates, that is a much bigger threat to global economic growth. You know, it also threatens directly developing countries. For example, when the Fed raises interest rates, you'll see capital flow out of those countries, and this can cause crises. So again, this is where the focus should be for anybody who's worried about the stability of the global economy. It's really central bank policy, and especially the bigger central banks like the Federal Reserve, the biggest in the world. I mean, the biggest, the bank that has the biggest influence in the world. That's going to be what we should worry about going forward.
Okay, and finally, as a consequence of this possibility of a trade war, the IMF recommends strengthening the multilateral trading system. Here's Obstfeld again, what he had to say about this.
There's certainly room to strengthen the multilateral trading system in several dimensions. It has been a significant support for world growth in the entire post-war period. And in fact, trade has allowed significant growth, not only in the advanced economies, but also convergence in emerging and low-income economies, with incredible advances in eradication of poverty and increasing a number of metrics of human welfare.
So, Mark, what does this mean, practically speaking? What are the consequences of strengthening the multilateral trade system, and what's your response to what he has to say about this?
Well, it's kind of an exaggerated and blurred statement. Sure, trade has contributed to growth, and the multilateral trading system has contributed to it as well at some times. Right now, if you look at an agreement like the Trans-Pacific Partnership, which the IMF and Obstfeld support, that's not really contributing to economic growth. And that's, in fact, you know, the most important provisions of these kinds of agreements are really economic, in terms of their economic influence, are the increased protection for so-called intellectual property, patents and copyrights. And this is just a drain of money from you know, various populations around the world to the pharmaceutical companies, to the owners of patents and copyrights, and raises the cost of prescription drugs. So this is more of an income redistribution and a very inefficient way of financing any kind of knowledge or research. And so this is what they're promoting when they say trade at this point. It would be a different story if he was talking, you know, 40 years ago, when you had the general agreement on tariffs and trade, and, you know, they lowered tariffs in a way that was negotiated more for mutual benefit.
Okay, well, I'm afraid we're going to have to leave it there for now. I was speaking to Mark Weisbrot, co-director of the Center for Economic and Policy Research. Thanks for joining us today, Mark.
Thank you.
And I'm Greg Wilpert for the Real News Network.